Hello there. Well, here we are again, another Tuesday evening, and great to have you on board. Nice to see familiar faces and some new faces too. Great to have you on board. I'm just going to put the pre-show marker on for a couple of moments, let people find their way in. And very interesting and important conversation this evening, of course, because of what's happening with the markets. Damien and I were talking a little while ago. We said, well, you know, the equity markets are behaving like we expected. They're going down and et cetera, et cetera. But the bond markets, what on earth are the bond markets doing? So we might well discuss the bond markets. We'll probably also discuss some of the events in the UK, because that's sort of connected with the bond markets and what's going on. And a lot of other things to talk about too. So plenty of interesting conversation ahead. And for those of you who missed the dog earlier on, this is the doggy show in pre-show mode. So Luna is the Kelpie on your right, and Meteor is the slightly smaller one on your left, which is the black and white one. So Meteor was having a big scrabble around and a dig. She quite often does that when she makes herself settled of an evening, so it's quite funny really. But they look pretty flat out now. They were much more active earlier on. Anyway, that's enough of doggies, and I'm going to take the pre-show off and run the introduction, and I'll be back in a moment. Well, good evening and welcome to this live stream on the 27th of September 2022. Martin North from Digital Finance Analytics here. Great to have you on board. And thanks for taking some time out of your Tuesday evening to share it with us. Great to have you on, and I'm enjoying some of the conversations in the chat already. We'll pick up some of those a bit later, particularly the RBA question. Is the RBA bankrupt or not? That'll be one we can kick around a bit. Anyway, before I bring Damien, let me just remind you that we don't provide specific financial or legal advice on the channel. This is just a general conversation. We do moderate the stream and the chat, so please no racial slurs. And I do encourage you to share your opinions and thoughts and engage in the chat room, but just do it nicely, please. This is as at 27th of September 2022 if you're watching in replay. If you'd like to ask a question, I do encourage that. Please use that Walk the World to make sure that I see it, so it goes into my queue. I've also enabled Super Chat, which means that you can get your question to the top of the list if you want to, or indeed make a contribution to what we do here. It's always greatly appreciated. We don't do this to make a profit. We do it because we think there's an important conversation to be had. That's that. Well, without further ado, I'm going to push this button and bring Damien in. Damien, hello.
Martin, good to see you again.
How are you doing?
Yeah, very well, very well.
And nice to hear you on the new mic. It's a whole lot better than the old mic.
That's right. So yes, we're just talking sound setups. So yeah, hopefully they'll it's a little bit easier to hear, and hopefully there'll be some words of wisdom to that people will want to hear.
Well, we'll see whether the comments think it's okay, but it certainly sounds good to me at the moment. And look, there's so much to talk about, and I'm not really quite sure where to start, but I think it will be good just for those people who may not know about Nucleus Wealth and what you do. You know, as head of investments, just introduce yourself, because then we can talk a little bit about the event that's coming on next month.
Yeah, sure. So Nucleus is a fund manager. We run both superannuation and ordinary investments for ordinary people. We focus on sort of two different areas, but the core of it is the name Nucleus comes from this idea that what we're trying to do is this core assets, the big sort of safe liquid assets, your blue chip shares, government bonds, and cash that we try to manage and try and sort of time a little bit in terms of leaning into the cycles or leaning out of them as events may occur, or you can just come straight to us for to invest in individual. Like an international portfolio or an Australian portfolio. So that's our what we call our active side of it. And then we also have a passive side where you can come to us and invest just in the market. And what we let you do though is it's called direct indexing or custom indexing. We let you change it. So it's like buying an ETF, except we actually let you change what's in the portfolio. And the same features in that we let people do across all our portfolios as well. So if you don't want banks in your portfolio because you already own them or because you want to avoid them completely, you can cut them out, or you want to have nuclear power in there, but you don't want carbon, or vice versa. There's all those sort of options people can do to change the portfolios for themselves.
Yeah, and of course the whole point about it is the tools that you have means it's horribly transparent, so everyone can see precisely what's going on, the good news and the not so good news.
Absolutely, and that's a key part to it, is because what we want to do is make sure that I spoke about it being a nucleus to your portfolio, and the idea is you can also put sort of other assets around that you might want to already own yourself or have from other places. You want to know what's in the portfolio. You don't want it to be sort of like a sort of bit of a black box super fund where one of them a few years back, somebody wanted to know how much carbon was in their portfolio, and they needed to sue the super fund in order to work out what they owned. So the idea is, we actually want to show you, here's every single stock you own, every single asset, and so that you can sort of fit that in with other things you do and other assets you own.
Absolutely. Now let's just briefly talk then about this event. Let's put this up. So next month you guys are running an event down in Melbourne. Will this historic bull market end with a historic bear market? Might be good just for you to give people a little bit of a sense of what this session is going to be looking like. And we're going to have the macro business guys there. I'm going to be involved, and of course you guys are going to be involved too. Yeah,
sure. So we wanted to, and we set this up a month or two ago, maybe 6 weeks ago, where we started to plan it, and I'm hoping I'm hoping, but it'd be nice if the bear market was over by then. But I'm hoping if the markets keep going the way they're going, we might need to change the headline. But it is very much the idea that what we really want to do is just talk about these big picture, longer term trends. How we see the portfolios over the longer term, and then just talk to people about the types of assets we do, what other types of assets are out there, and just give people a chance to come up and see in person and ask questions and meet the team.
Yeah, and so there's a link in the comments below the video if you want to sign up and register to go if you're in and around the Melbourne area. It's is it the 19th, I think, of October? Is that right?
Yes, I think so.
Yeah, I think it is.
Check that link again. I was hoping you were going to bring it up and I could remember, because I haven't got it written down in front of me.
We'll check that later, but I believe that's right. I believe it's the middle of October, early evening, and should be interesting because you'll have the macro business guys there, of course, who are involved with Nucleus, as well as myself from the What the World perspective. And we're going to sort of kick around some of these big picture questions and try and, I guess, tease out some of the most interesting and, difficult questions perhaps to face, because, well, frankly, there are a few difficult questions just now, aren't there?
Yeah, absolutely. And I think as well, one of the key things we want to try and do with the night is, there's always the day-to-day and week-to-week stuff that we talk about every month here. And I do a podcast myself every week, and we're blogging, and the guys at Macro Business are writing, on a daily basis on a lot of this stuff. What we're really trying to do is a bit of a step back and say, well, there's often a feeling for people, especially newer investors, who are like, right, I've just read whatever book, and I've just read The Barefoot Investor, I've just read something, and I want to start getting invested, or I've just rolled out of the housing market and I want to start getting invested. And it's that idea about going, well, things move in bigger, longer term cycles. You don't have to feel the rush to rush straight in and do something, but having that idea of, look, what does the playbook roughly look like, and where do we see these longer term trends taking us? And so you can sort of think about it from a sort of that bigger picture stance, and and stage your entry and sort of, I think, or at least have a if you are invested, sort of have a better feel about as where the down circles are, where we're expecting the next up cycle to start. What are the road signposts along the way that are going to help us to tell where we are and what we should be doing.
Yeah, and let me put this slide up because it's one I picked up today, which I thought was quite interesting. So somebody has drawn a sort of a mirroring chart between 2008 and where the current US market is, right? And basically, it seems horribly resonant. Now, I'm not saying that history repeats, but it may rhyme a bit. And if that's the case, are we under halfway down the slide, I guess is the question. I don't know what your view is, whether in fact there are similarities to 2008 or whether it is very different this time, because of course this time we've got high inflation. It wasn't quite the same last time, but interest rates are rising as they were rising last time. So I'm interested to get your take a bit on 2008 versus now. What do you think?
I see these charts fairly often, actually. I think they're it's a good indicator that as markets are falling, you can get these really, they call them face-ripping rallies where, the market's up, it drops 20, 30%, and then it roars back 15%, and everyone's like, oh, it's all back on again. And then, you get another 20, 30% downside, and then it's, you're up again. And so I think some of this is really just as events are playing out, it's the way the shorter term traders are reacting, and I guess it's the hope that maybe something will come along, and actually not even the hope, it's the possibility that something else will come along as well. So I'll talk about that. You see these crises coming, and a lot of people sort of are very much out at the moment. Talking about recession, and we've obviously been talking about it for a while here. But as that starts to become a reality, it's the part where 6 months ago there's a bunch of people going out, yeah, maybe, but the Fed will come and save us, and then the Fed's like, no, we're busy trying to get rid of inflation, and then it's the part where people go like, well, they say they are, but they're probably not really when push comes to shove, and then push does come to shove, and they do say they're going to keep sticking with that inflation fighting, and it's that gradual realization, and that often sees markets sort of go in this direction. Now, what could make you go down that sort of that really big slope that we saw in on that chart? Look, this is there's a couple of things that can go wrong. So and I feel as if I'm starting down a path myself, a slippery slope, where I think I could spend the rest of the podcast talking about this one. But let's just talk about where the big imbalances are, because that's what you want to know. If you look at the consumer sector in the US, it's actually not that leveraged. It's actually relatively healthy, given how long the bull market's been and all that type of and all the factors that are in there. In Australia, that's not the case. So Australia is particularly leveraged in terms of the housing market, and we haven't seen a housing price fall. But yeah, the US saw their big house price fall, and also in Europe they saw some big house price falls, whatever it was 15 years ago, and they don't have quite that same mentality that prices can only go up. So prices are high in terms of housing, but they're not anywhere near the heights we're seeing in Australia. So if do I see something centered on the US consumer? Probably not. In terms of US corporates, there is a fair bit of debt floating around in US corporates. It's not too bad in terms of the way it's positioned. Like a lot of the debt, a few years ago was focused really on the energy sector, and so they've just been raking in cash now and sort of really managing to bring that back to more normal levels. So there are some debt concerns in the US, but there doesn't seem to be a flashpoint at the moment. In terms of governments, is there a chance of emerging market crisis? That's probably the most likely. You've already seen, there's issues in Turkey. You've seen issues in Sri Lanka, places like that. As we keep seeing the US dollar strengthen, and as we keep seeing the Chinese yuan weaken, both of those, individually are both recipes for problems for other emerging markets. So could you see something, crop up in emerging markets? Yeah, that's one place. The most likely place is China. And especially in terms of, we've spoken ad nauseum on these about that huge overbuild in terms of China and the issues there. So that's one quite likely place. Having said that, it does seem as if they are on the case enough to turn it into a very, very long and drawn out problem rather than an acute problem. So this is that's your other definition, is do you get into the problem where you get a crisis that that central banks and governments, can't get in front of, and prices all get carried down, and you get these big washouts. It does look like China's trying to go the Japanese route, which is basically extend and pretend, and you get the bigger property developers to buy the smaller property developers, and the healthier ones to buy the unhealthier ones, and now they're starting to get governments, SOEs starting to try and help finish projects, and there'll probably be bad banks get thrown in there, and there'll be all these other things. So maybe that's an acute crisis. I think the most likely for the next leg down of equities is earnings. So the earnings have fallen a little bit so far, but really not anywhere near the amount you'd expect, given a number of the other factors out there. And I'll go through a few of those actually. Some of these manufacturing new orders and stuff like that. Some of which that are usually pretty good leading indicators as to earnings, and they're all at recessionary levels now already.
Well, we'll come on to the earnings a bit later, because I think there's an interesting contrast between the US and Australia and some of the different PE ratios that we're seeing. But there's something I want to explore first, and that is the UK, right? Because the UK bonds has just shot through the roof, and in fact, this is the 2-year, right? This is the 2-year bond. So it's currently sitting. This is the UK 2-year bond, currently sitting at 4.2. It got up to 4.5, the other day, having taken off literally in the last few days. And of course, this is all to do with what they announced in the UK with regards to effectively more stimulus and borrowing more money and all those sorts of things. But this was a remarkable movement in the bond market, and really, I guess the question I've got is, knowing what I know about the bond market, this is quite important to try and understand, because it seems to me quite significant. What do you think?
Yeah, absolutely. So we've effectively got a government working at odds with its central bank. So they're doing exactly the opposite. So they're trying to jam the accelerator on as fast as they can. At the same time, the central bank's got both feet on the brake, trying to bring it to a stop. So it's this question about, and we've spoken before about independent central banks and what does it mean, and this is one of these issues where is this just a natural extension of 20, 30 years ago, it used to be that we didn't have independent central banks. The government would actually run both the monetary policy and the fiscal policy, and they'd choose, which lever is the most appropriate and which one will we use at the right time and all that sort of stuff. And then they sort of went, well, it's much better if we get interest rates to be run independently, so that you've got the technocrats can do it, and they don't have to worry about they haven't got the same thing about having to get voted in, and so they might run it in a better fashion and all that sort of stuff. And there's certainly lots of truth to that, which is why it sort of spread right around the world. But then the question is, well, does that mean now that this is just taking it to the natural extension? Is, well, the government will try and do all the nice stuff, and if there's any problems, we'll let the central bank. That they're the ones. So there's a decent argument out there at the moment that they're just going to flood this money with liquidity, and if inflation takes off, well, that's not our fault. That was the central bank should have raised interest rates more. And if the economy crashes, well, they were too hard on the economy. We did everything we can to stop it from crashing, and so it looks as if it's a politician sort of washing their hands of the economy and just sort of saying, we'll let the central banks take the blame for anything that goes wrong in either direction.
Well, they're talking about, we need to think long term rather than short term, and we're investing for the growth in the future, etc. But interestingly, this has real world consequences now, right? So effectively, there are some mortgage companies in the UK who've now stopped writing new mortgages.
Yeah,
because they've no idea what they should be pricing them at. Yeah,
and it's that, as you said, it's that we're investing for the future. Here, everyone have a bunch of money and good luck with it. It doesn't seem to be a lot more thought behind exactly the problems we've seen over the last just sort of 10, 15 years. The whole trickle down. The idea is that if we give lots of money, lots of tax breaks to companies, and give lots of tax breaks to the top earners, then all that money will trickle down and everyone will benefit. And it's been shown not to work, repeatedly. But it's we're going to give it. It's obviously very attractive if you're rich or if you're a part of a business think tank, then it's very attractive to say more tax cuts.
Trickle down economics again. Reaganomics, the Laffer curve, all coming back into play, despite the fact that many other people have argued that it really hasn't worked over the last 20, 30, 40 years. Interestingly. And it is worth saying though, that those economics did work when the curve had pushed too far the other way. Yeah. That
you had 60, 70% tax rates in England, and you had vast levels of big shutdowns from unions and wages and all that type of stuff shooting up because the sort of preempting wage rises and things like that. So there was reasons at one thing, but this pendulum's already swung so far to the other direction that now to argue that it needs to swing even further is seems crazy. So bond yield's much higher, and so it's almost a bit of a, well, it's not almost, it is a bit of it's a risk premium that the market, the rest of the world's putting on the UK. They're basically saying this looks crazy. Why are you guys doing that? That means the central bank's going to have to raise rates way higher to rein in the economy. You end up with sort of two titanic forces pushing against each other, and you don't know which way it's going to go. It's probably going to overshoot in one direction, but you just don't know which direction.
Absolutely. And then let's overlay the other view, which of course is the pound US, right? Because it was actually down close to, well, it was 1.03, I think it got to, worst case, right? And all of the people in the UK were saying, whoa, this is terrible because it basically, we're going to import inflation, et cetera, et cetera. And the Bank of England came out and said, well, we'll put rates up if we need to, et cetera, et cetera. And so it's come back up a little bit. It's now 1.08. But I guess the interesting question, how much of this is actually to do with the strength of the US dollar, because our exchange rate has also dropped, and how much is it being driven by those quite weird policies that we've just discussed, where effectively, hang the short term, we're going to actually borrow a lot of money, we're going to go for growth at all costs, and this is the consequences. Well, to my mind, the market here is really, I think, indicating quite clearly what they think about it, which is, as you say, a risk premium on the currency and a risk premium in terms of the higher interest rates. And those two things are connected, aren't they?
Yeah, absolutely. And I think it's probably more, it's this thought that is there policy process and is there economic rationale behind what's happening, or is it, or are we at the stage of driven by ideology? And it does seem as if it's driven by ideology at the moment. Maybe they're right. Maybe they've, it is interesting if you're not in that country to see it as an experiment and to see, does it work? Because it hasn't worked anywhere else, but maybe it'll work this time.
Maybe the UK is different. Who knows?
But it does seem to be ideological driven, which is why markets have been so concerned. Because then they're saying, well, this is just, so what happens if the central bank raises rates even further and the UK economy starts to crash, despite all these, do they double down? Do they go again and give away even more money? Are they the issue? I get the inflationary issue of a falling currency, but I do think there is an element of that's a one-off effect, and that should be looked through unless the currency is going to keep falling, and so. And I guess that's the thought process as well. If you can't trust the government in terms of decisions, maybe the currency will keep falling, but it will be good for exporters, UK exporters. So this is, it's one of the things that for Australia, we've obviously got a falling currency as well, and a great thing for exporters and great thing for for us as in terms of diversifying away from the sort of houses and holes economy that we keep complaining about. We'd like to make stuff or have services here that other people want to buy from us, and a lower currency very much helps that. In that, I often use the example. It's not even a manufacturing example anymore, because Australia doesn't have much in the way of manufacturing, but it's your multinational who needs to stick a new lawyer into their Asia Pacific division, and they're like, well, I can stick them in Japan, I can stick them in Singapore, I can stick them in Australia. Which one am I going to do? And if the Aussie dollar's just fallen 20%, well, now it's 20% cheaper to hire somebody in Australia versus hiring somebody else. And so, there's a reasonable, given how much Australia is services, that sort of is sort of the way that the currencies sort of end up sort of having to rebalance excesses.
And just talking about the Aussie, this is the latest, so it's at 64.88 at the moment. And in fact, the question for tonight, the poll, which I put up earlier on, is where do you think the Aussie dollar is going to be in a year's time? And I put 4 options there. So if you haven't made a vote, go make a vote on the poll there. And at the end of the show, we'll share where people think the Aussie dollar is going to be in a year's time.
Yeah, it'll be very interesting to see. So, I mean, we obviously spoke last time about. I feel like we were at 70 cents last time we were.
Yeah, well, just knocking around 70, 71. Yeah. Yep.
And I spoke about the Aussie dollar acting as a shock absorber on international investments. And that's, exactly what has happened there is that it's this idea that because Australia is a high growth economy. So what I mean by that is we're leveraged when the world economy is going well, we usually go really well. When the world economy is going badly, then Australia goes even worse, and it's because of the big mining exposure and that sort of leads to that a lot of that volatility, and so and what that means as Australian investors investing out, it actually gives you that element where as you're investing in international stocks. When markets tumble, if the Aussie dollar also tumbles, so that markets might be down 15%, the Aussie dollar's fallen 10%, or now you're only down 5%. On that actual investment, whereas an investment in the Aussie market at the same time, if the Aussie market's fallen 15, you're obviously down 15 on that. Then when the market goes the other way is when you want to start looking to try and work out, can I hedge my international holdings when you think the currency has bottomed. Some people sort of make an argument to say that you should just hedge all the way through the cycle, and so you get a pure exposure. I'm very much against that. Currencies go up and they go down. The net effect of it is if you started at say 80 cents and we go up to $1 and then we go down to 60 cents and then you go back up to 80 cents again. If you've hedged the whole way, all you've done is paid an insurance premium. It's effectively sort of paying an insurance premium on your investment, and it's dragged your investment down. Whereas on that same investment, if you'd stayed unhedged, you've made the same return. And ideally, when the Aussie dollar is getting closer to $1, then you're leaning into it and loading up, and getting more international assets. And then as the Aussie dollar is sort of getting closer to 60 cents, now you're starting to think, well, okay, now I need to start thinking about, do I hedge at this point, and how much lower will it go before I start those hedges?
And talking about how much lower can it go, it's also worth, I think, looking at this one. This is actually the iron ore in Singapore, right? And it's now sitting at 98.43. And of course, we were at one stage not too long ago, 220, right up there, right? Now we're at 98. And that, of course, is also another factor into the mix, isn't it? Because that translated for a period of time into quite significant tax revenue into Australia, right? And that's one of the reasons why we had that $50 billion windfall which the Treasurer announced the other day. But now prices being lower, we're probably going to see that dissipate. So that's another factor in the mix.
Yeah, a bit. Where we will get a windfall from is coal, right, at the moment, because the coal price is off the hook. So we should be getting, as we talk about every time I'm here, we should be getting a windfall from gas, because we're one of the world's top 3 gas exporters.
But we have to pay the same as everybody else, right?
But we don't. No, we decided not to charge them. Anyway, listen to any of those other podcasts. I won't waste time. But Australia just does not benefit from gas. But we do really benefit from coal, and the coal prices are dramatically higher at the moment. So that is going to help us. But the other thing is that iron ore, though, that was our biggest earner. And you can just see that crazy volatility on that chart. Like, from 2021, or 2020, that we're at $80. So you've gone up 3 times almost over the course of 18 months, and then you've more than halved it, and then you've added another 60% or 70%, and then you're down 40% from there now. So it's just crazy volatility in that part. The biggest thing for the iron ore price is the Chinese housing market. So if you have the view that, look, China's just going to kick the can down the road and all of a sudden they're going to throw all this extra money at the housing market, they're going to get rid of these debt limits and all that type of stuff like that, then iron ore is a great bet for you. If you're of our view, which is that's not the case, then iron ore's been a question about how to avoid exposure and be underweight that sector, which is a big part of the Australian economy. So they've obviously got a big meeting coming up in another month or two, and there are people out there who are saying post that meeting, it's all going to be back on again. So they're going to be, they're going to take off all the limits and they're going to go for growth again. Maybe they will. I don't understand it though. If that's the case, I would have thought, if anything, my expectation would have been they would have let things be a bit looser going into that meeting, because if you want to get voted in for life, and heaps of people in China and heaps of particularly senior Communist Party executives rely on money from housing markets in China. You want that housing market to be relatively good going into that meeting, so they all stamp yes. But yeah, anyway, we'll see what happens.
Politics.
Yeah, that's right. And that's
one last slide I just wanted to touch on before we move on. That's gold, right? The price of gold is quite interesting insofar that it's sitting at, well, it's 1643. This is the futures contract on gold at the moment, 1643 US. And of course, everybody thought, well, hang on a moment, isn't gold meant to be a hedge against inflation? But it seems to be it is an anti-hedge at the moment. Is that because of the US dollar, the strength of the US dollar? Is that the reason why it's doing what it's doing?
Yeah, it looks a lot better in most of the currencies. One of the things I look at gold as or one of the most important things I look at it as is a currency. It is an alternative to these other assets. But I think from if you're a gold bug, a true believer in all these reasons why gold was going to go to the moon, then I think you'd be pretty disappointed at the moment. There's been a lot of things go right for gold in terms of all the expectations of people who are saying, okay, if inflation gets out of control and we have concerns over the Cold War back on, problems between China and the US, problems between Russia and Europe, all these things going wrong that sort of all point towards reasons for gold to have a solid bid, and it's been going the other way. Is concerning because the other, the real. So I spoke about currencies being an alternative currency being one thing. The real thing that it really is a bet on what other people are going to be doing, and so the biggest holders of this is other investors and governments. So if you think they're out there buying, then you should be trying to get in front of them. And if you think they're selling, you should be also trying to get in front of them and get out the other direction. And so partly it might be a reflection, or I think it probably is a reflection of the liquidity being drawn out from the market. And so as the liquidity disappears, then that loses that sort of safety bid that it had. And what I mean by liquidity is central banks for the last God knows how many years have been out there buying government bonds and really supporting, trying to pump more money into the system. And now they're doing the opposite. They're trying to withdraw it. So,
yeah, that's right. And it's an interesting conundrum, right? But it's worth. And I come back to this all the time. There is the the underlying gold, and then you've got this derivatives. Infrastructure over the top, 50-1 relationship between the derivatives and the underlying. And somebody pointed out to me the real leverage on that, if you think of a futures contract, it's about 26 times leverage on the margin call, right? So there are people basically making a lot of money on these movements in gold and essentially have every interest in not letting it go too far from a particular point. And when it goes down, they're making money. So that's part of the reason why we've got this thing. So you can't think of gold as a pure commodity, right? There's a lot more going on here.
Leverage as well. And look, I think one thing to think about for all commodities, I mean, I often talk about this as an investment philosophy about saying, well, I want to know, before I start with any new alternative asset, I want to know, why am I making money from this? So I get it for equities. I'm supplying capital, and then I get the profits from the company. So I get that, or debt. The company wants debt. They're going to pay me an interest rate. I can understand why I'm making money from those. Foreign exchange. There isn't a reason to make money. Like for every currency that goes up, there's a currency that goes down. So really, you're just talking about relative play. So there's not, like, if you're just a long-term currency investor, commodity investor, foreign exchange investor, you're not actually, there's not a fundamental reason for you to make money. Commodities, the reason why people make money from commodities is you're sort of like an insurer, really. There's an insurance premium in it, and the reason why is because producers want to hedge their exposure. So they know that. They're a gold producer. They want to make sure they get at least $1,600 because that'll cover their costs and things like that. And so if the gold price tumbles by 30%, they don't want to go broke. And so they're happy to basically have a bit of an insurance premium to make sure that the stuff they're digging up, they can sell at the price that makes a profit and the company doesn't go broke. And that goes across most commodities. There's that underlying sort of insurance part of it. And then over the top of that, you then get the speculators sort of taking advantage of the systems that have been set up to provide to help provide insurance for these companies, then get used for people taking positive bets and negative bets and all that. And as you said, the gold market's a great example of that, where the producer hedging is a fraction then of the amount that other people are out there betting on these as well.
Absolutely, it's like everything else. Once you start peeling back the onion, it's a bit more complicated below the waterline. And talking of complicated below the waterline, let's now talk a little bit about valuations, right? Because it's interesting that now the US view of forward earnings is already sliding a little. We saw through the last round in Australia a number of corporates refusing to give forward views as to what the earnings is going to be. And they also announced a number of share buybacks, which is another way of keeping the share price up. So there's a whole interesting conversation, I think, to be had here about the earnings story and what's really going on.
Yeah, absolutely. I might actually, before we jump into the earnings themselves, let's look at a few of the forward indicators. I think I might bring up, so there's probably good timing for. Got a chart here of
let's just bring that up now.
Some of the surveys. So.
There you go.
Company earnings. So I'll start by the description of how company earnings comes about. So the earnings we see are consensus forecasts that come from stockbrokers who cover the companies. And so the big names you hear. So if we're talking about Apple's forward earnings, you're talking about Bank of America, Merrill Lynch, and Goldman's, and all Morgan Stanley, all these analysts at each one of these, and there'll usually be 20, 30 analysts covering these stocks at big places, and they'll all put their forecasts in for what they think the company's going to earn. Now, it sounds like that's sort of a bunch of independent people coming into a view and then making assessments on that. The reality is they all ask the company, how much you think they're going to make next quarter, and the company sort of has a bit of a guess, and then the analysts sort of put a little bit of flavour around that, but really they're all in a pretty tight bunch around what the company's basically told them, and companies will actively, like if everyone else thinks the company's going to earn 5% and you're out there with a 15% earnings growth. I've been an analyst where you've gone out with these really bullish forecasts because you think you think things are going to be great and all that type of stuff, and the companies will come and they'll be like, oh wow, you're really up there, and oh geez, so that's a really hairy chested call, and how do you think that's going to happen, and talk you down, and then they'll talk you down to 10%, and then next thing you do, they result and they've done the 15, and you're like, just a minute, I was forecasting that, you spent all this time talking me down. So that they like to sort of not massage the numbers, but they like to try and keep people sort of in a reasonable range, and there's always games people are playing in terms of trying to under promise and over deliver and all that type of stuff. But the net effect is analyst forecasts for the first year really do come from companies. Then where do the companies get them from? Well, the companies, depending upon how the company's put together, but most of the time, they'll basically go to their sales force and they'll say, well, how much are you going to do? And the sales force tends to say, well, we did 10% last quarter and things look pretty good, so I'll probably do 10% again this quarter. That's basically that's as complicated as it gets. So when you see these big interest rate rises, you see dramatic changes in terms of supply chains and all that type of stuff. The salesperson on the end, who's basically filtering it all the way up to the analyst, they're not economists and they're not supply chain experts and all that type of stuff. They're just saying what they're seeing. And so what you tend to see is at turning points, the company forecasts tend to lag. So what do economists do, and strategists and investors like myself, like we look a lot more at big turning points in a lot of the surveys. And that's exactly what we're seeing at the moment. So we're seeing this is a Philadelphia Fed puts out this manufacturing new orders, and basically zero means you think the orders are going to be the same as whatever they were the prior month, and a negative number is below and a positive number is above. And so in aggregate at the moment, we're at recessionary levels. The only times we've been as low as where we are now is the pandemic, or in the last sort of 15, 20 years is the pandemic, and then 2008. If we go to delivery times, we had this huge problem with delivery times, where delivery times really blew out. Well, they've all come right back in now, and delivery times are now falling. Sort of coming and keeping in mind that are they going to be better than last month? And so we're back to very much normalizing levels, or again sort of similar levels to what you last saw in 2008. If you look at the shipping prices, so shipping prices sort of hit over $12,000. This is just one example. They're all pretty similar, but Shanghai to LA is one of the most popular ones used. This one here was from about a week ago, and it was at 4,200. I think it's fallen about another 10% now. It's back in the threes at the moment. So that's showing exactly that same sign. A leading indicator for used car prices is this wholesale index that sort of takes a little while to filter through into your actual retail. Now that's turned pretty decisively down. It's still miles up on where it was a few years ago. It's probably double the level it was a couple of years ago, but it's pretty decisively turned down, and the expectation is that continues to fall as a lot of the car manufacturing issues are now falling behind us, and demand starting to weaken as well. If you look at this one, sort of does a similar one for cars, but it's looking at auto dealers' inventory. So and it's put it upside down. And then looking at how that affects. So when inventories are falling, car prices rise. So I haven't got enough cars on my lot, so I'll sell them at higher prices. And then when my inventories get full, that's when car prices tend to fall. And so so that inventory has been advanced by 12 months. And so the expectation is that sort of black line of new vehicle prices is going to follow the yellow line. Sorry, the blue line down. Actually, I'll do container traffic later. Actually, but that's just a sort of a rough guide. Actually, no. Let me do. So sorry, I should do the container traffic because that's one more as well. This is the number of containers that have left a port somewhere in the world for the US. So it's a bit different to how it usually gets done. So usually what you see is how many containers arrive in the US. And those numbers last month were pretty bad. It was basically LA had one of its worst months ever in terms of the decline in the number of containers arriving to it. But the rest of the country actually wasn't too bad, especially the East Coast was actually not too bad. This one is a different one, which looks at it from where it's left. And the interesting thing with this, and it's actually not a particularly good graph, so I might have to explain it because it doesn't look as dramatic as it actually is. So over on the left in 2019, we can see it's about 100 TEU, which is the number of containers sort of coming through. Big spike as pandemic happens, and then a big fall afterwards, and then it basically ends up though afterwards we've gone from 100 TEU to about 200. So sometimes it's over 200, sometimes a little bit under, but we spent 2 years there basically doing about 200 TEU into the US. This line started falling in June, so we're only 2 or 3 months into this, and most of these ships take sort of can take a number of months to get where they're going, especially with all the queues that have been there. And these numbers have almost halved. Well, they had halved last week. They bounced back a little bit this week, but they're still down 40-something% on prior levels. And so there's a lot of signs that sort of suggesting that earnings are really going to get hit. Like this is the front end of it. There may be something else will happen. Maybe companies will manage to ram through more price rises. On the back of inflation. Maybe that'll stick. Maybe there'll be UK style flooding the market with more stimulus and trying to get things going again. Maybe wages will get held down and companies will manage to let employees take most of it. But at the moment, it looks like there's a wave. It looks like to me there'll be a wave of earnings downgrades yet to come over the next couple of months. And just to be clear, that's US, isn't it? We're talking here. These are all US metrics, right? This is all US stuff. Exactly. Yeah. The Aussie stuff's a little bit difficult to. Yeah.
There's not so much transparency, is there? Unfortunately.
No, and the issue is what you need to do with the Australian ones is separate. So the banks and resources in Australia make up sort of close to 50% of the market. And that's just not the case overseas. You just don't see that. So if you break out the banks and resources, which is what I tend to do, is say, well, let's look at those. Then you sort of also run into the problem that there's some of the big companies in Australia, say a CSL. Notionally, it's an Australian company. It is. It's from founded here and listed here and all that type of stuff. But it actually sells most of its goods overseas. That's where it makes most of its money overseas, and so it really is an international company. And so there's that question about you need to dig a fair bit lower before you actually get into seeing what's happening with companies in Australia. What's happening with companies actually who exclusively sell to Australia. And that can be different that can be quite different to what the actual ASX is doing, because the ASX might be doing something different because of the bank's resources and all these international companies might be doing something different. So yeah, I am talking though broadly US, but because that's where all the better data is. But a lot of it really is global. I think about them as global companies that I tend to look at from this perspective.
And anyway, what happens in the US is so critical to all the other markets because they drive the financial market. The US financial market is still the biggest and is the most influential, as we saw through the Fed. So it makes sense. It makes sense to understand it.
Yeah, and our 10-year bond rate follows the US 10-year bond rate more than anything. Yes, yeah, absolutely.
I would say that our RBA governor follows the Fed as well. Right?
Yes, absolutely. Yeah, I mean, there's a pretty good argument on that front. that we just haven't seen we're doing the same as the US. We're not that far behind them. And keep in mind as well, like it sounds. Keep in mind the US doesn't meet as often as Australia, so they meet about once every 6 weeks. So when they're doing their 75 basis point increases, Australia's doing a 50 basis point increase every month. Well, Australia's that's roughly the same. If you're doing a 75 basis point increase every 6 weeks, and so. We're not actually that far behind the US in terms of our rate rises, and we're not seeing the same wage growth. We're not seeing the same inflation numbers. We're not seeing there's just it's quite strange, to be honest, that we're following them so closely but without having the same economic conditions.
Well, just on that, please explain then. This is the ASX 30-day interbank cash rate, right? 4.3, 4.3-ish. 4.3 into 2024 is what the market's saying, right? Which is way above what I think Phil Lowe was indicating earlier on. But if that's true, then we are absolutely just following the US, aren't we?
Yeah, absolutely. And so all this year, I feel as if I've been pretty much every time I've come on here, I've said to people, get yourself into international assets because the Aussie dollar is going to help protect you. Get some get some US dollar exposure. Hold lots of cash. Equities isn't the place to be this year. And then get your money into bonds. And so all of those have been good, except that bonds call. And the question for me now is, not scary question, but the question I'm contemplating is because my expectation was that markets would be pricing as earnings start to fall, markets will start pricing in these recessions, and they are sort of pricing in recessions, but not really, not to the extent that I would have expected by now, and so I guess my investment expectation is that those bond yields will move lower. The longer term bond yields, the shorter term ones will stay high, but the longer term ones will move lower. That'll give you an investment gain on those. And then we'll switch into equities and ride that next cycle of the equities up, at 6 to 12 months in the future. My concern is that maybe equities don't start rising until bonds start falling. Yeah. Maybe if they keep going the way they're going for another 6 months, then maybe it's you don't have that opportunity to switch. You just got to switch back into equities and go for that equities ride. With an important disclaimer, we're not there yet on equities, I don't think.
No.
I think there's
more downside on equities, what you're saying, yeah?
Yeah. I mean, obviously we've had a lot of the downside, so it's not a terrible place to buy. There are, for longer term investors, and maybe you'll get a bunch of positive events will all of a sudden happen and equities will get carried off and off they'll go and now will have been a great time. But I am expecting to see more earnings downgrades. But give it another 10% and we'll be starting to lift our weights, probably subject to what's going on. And markets are down 20%, another 20%, and we'll be starting to get closer back to a more normal weight for us. So.
Yeah. Well, there are people out there like Harry Dent who's saying, we've got a long way to go, and there are others saying, well, we're close to. But it comes back to the valuations question, right? Because the valuations in the US, I still think, are pretty full.
Yep.
The valuations
downside come from earnings.
Yeah. The valuations in Australia, look at the banks, for example. I still think the bank valuations in Australia are silly. I don't understand them. They're way too high.
No, and they're 60% higher than similar banks overseas.
Yep.
So they're incredible in terms of how much higher they're priced than banks anywhere else. Actually, one other thing. So earnings is one part. I guess the other question is central banks. So they're obviously they want to steamroller inflation. And that's more and more you just get out of them is these comments. I was listening to one of them talk on a podcast just the other day, and he was talking about how what they'd really taken from the 70s is the slightest sniff of inflation, you need to stamp it out, and you need to keep going until you're absolutely positive it's dead. Yep. And so you're going to run it over with a steamroller, and then you get back the steamroller up, and then you're going to run over it again. And the question is, are they going to do that? Is the question for me is, are they how deep of a recession are they willing to cause? Because inflation. So I'm looking at US inflation numbers again because that's where the Fed's going to be sort of most focused on. Now, I showed you some of the prices and stuff like that on used cars, and so I've got this sort of view that that part's going to be falling quite quickly. We're now starting to get negative inflation out of the energy sector. The oil sector at least. I do think we'll keep seeing rises on the utility prices over there. A number of other ones like your household furnishings and all that type of stuff, where I'm expecting that to sort of revert much more quickly back to trend now that we're seeing big drops in demand. Having said that, even if I'm quite sort of aggressive in terms of basically saying we've got deflation every month from here on in terms of prices going backward on a month-to-month basis, the annual inflation will still be well above 3%, early next year. And so will the Fed keep raising rates? They've got 2 more goes this year, another go again early next year. They might still be raising rates into that. And so we might have seen 6 months of deflation, but they're still raising rates because the annual inflation is still way above their target. And if that's the case, and they keep going at that, and they say, yes, we get there's been some deflation for the last 6 months, but we really need to stamp it out. Maybe they drive it into a deep recession, and that's where you can get some Harry Dent style, downturns and some big concerns. Because keep in mind, the last 2 months in the US have both been flat in terms of there's been no inflation. So it's 0% on the prior month. So it's just that we're cycling such huge gains in recent months that we're going to keep seeing that for a while.
Effect, right? So basically you've had all those big moves, they'll work through and then drop off. The interesting question, of course, is that one of the things that did show in the last inflation read was rents and housing, right? That's still rising. So it's being offset by falls in oil. So it was a net wash through because oil prices came down a long way. But the question is, are we going to see the same drop in oil prices next time? No, we're not.
Right.
So the question is,
you'll see some cycling of lower prices, though. The base effects will help there. But you're right on that. On the rents are going to keep going up, and the way they calculate it as well. There's some weighted averages and stuff like that in the way they do it.
It's delayed,
and so it's going to keep going. Yeah, that part of the inflation is going to keep going up for some time yet. Yep. So I guess that's what I'm saying is when I put together some, what I think are relatively, relatively kind to inflation, sort of along with my view about saying, I think a lot of all those cycles we showed before of all these things turning and coming down, if most of those come through quite quickly, inflation is still going to be annualized inflation is still going to be high for some time.
Yeah, absolutely.
So there will be cover for the Fed to decide that it really wants to cause a deep recession rather than just a little bit of a recession.
And recently Powell said he was comfortable for house prices to go lower. In fact, he said we need to have a correction in house prices, which is interesting. So that was literally in the last few days. And we also had a number of the other Fed chairs in some of the other Fed areas talking about we need to actually see unemployment start to rise. So they are sort of talking themselves into a significant slowdown, right? Whether it's recession or not. Depends on your definition of recession, I suppose, partly as well.
Yeah, absolutely. And as you said, the unemployment's the part where that's where the rubber hits the road. So if that's the part that causes the problems when that really starts to rise. And so and also I did say that it's not the corporate side of America does have there are pockets that still have a fair bit of debt. So and as they start to have to roll over their loans, like there's a lot of them who got 2 and 3 and 4% loans, similar to the housing investors, and now they're going to be refinancing at 6, 7, and 8%. For some companies that's going to be too much for them. So that there is that potential to cause. It's not as much of a worry at the moment, but certainly it's I wouldn't forget about it, especially if, as you said, it depends on how many times the Fed feels like it needs to run the steamroller all over.
And it's very interesting because, of course, Powell is now channeling Volcker, right? As the great example of the hero who rode in over the hill and crushed inflation. But interestingly, back then, they got a lot of help from fiscal. There was a lot of fiscal stuff that was done in parallel. So it was actually where you had both the Federal Reserve and the Treasury marching together. Now, I don't see that quite happening at the moment.
No, but not only fiscal, but the microeconomics as well of it, because there's some pretty reasonable arguments I've seen out there that are basically saying that a lot of the crushing of unions did as much for bringing inflation under control as raising rates did. And so while there's some people who hear that and will immediately think I need to rush out in there and crush some more unions, it's like no, they've already been crushed.
Yeah, exactly.
there's not, you can't do, there's nothing left. Or, the levels are so low now. So, and that's the argument that we won't see the same levels of wage growth because you just don't have that same union pressure. But Australia.
But the implication of all that is that it may well be harder to crush this inflation out than some central bankers were thinking, right? And the UK is sort of saying the same. It's going to take a lot of...
Well, the UK is different, though. Yeah. Well, UK is... And in that they've just unleashed a flood on one side. And also the energy side of it in Europe is very different. Not to say that we're not going to see energy prices rise in the US. We will. But they're not to the same magnitude that you're seeing in Europe. And so... I can't remember. Is it £5,000 extra? I think I saw for some people was without some of these caps they've put on there. But there's going to be that sort of type of rise in terms of people's people's energy bills. And I don't know about you, Martin, but I'd probably notice a £5,000 increase in my utility bills. That would
it would certainly be a bit of a shock to the system, to put it.
Yes, that's right.
To put it politely,
there might be a few less cappuccinos bought that next quarter. Yes,
that's probably right. And the other interesting observation, of course, is that commodity prices like lumber, for example, things like that, have actually come back a long way too, right? So you'd have thought that some of those lower prices would also help in some of those input costs.
Yeah, so the PPI stuff, ex energy PPI is quite low, and you note so China, which is producing a lot of this stuff, has got very low inflation, and so there's a reasonable question about when they start to start exporting more deflation as well. So the Chinese yuan's been falling, inflation's very low there. They've been adding extra capacity. It looks like there's just been a sudden drop in the amount of demand coming out of China, which probably means they're going to, they've got all this excess capacity. They're probably going to cut some prices to try and get some more demand going. So there's a reasonable, despite what I was saying about that, I think there's going to be, for the rest of this year, inflation's going to be sort of hanging around in the US at quite high levels because of base effects. On the flip side, into mid next year, there's a reasonable chance you've got deflation. Especially if all these central banks keep raising rates and it affects demand the way I'm expecting. Then it could easily flip and go to deflation.
Right. And if that happened, guess what? They then cut rates, right?
Yes, absolutely.
And we go around the circle once again.
Yeah. But the question is how long. They're not. Yeah. How long would it take them to cut rates?
Yeah.
I think it would take a while.
Yeah.
I think if they didn't, let's say the US, I think market pricing has another 75 basis points next quarter, next meeting. They've got another one in December. They do another 75 then, maybe a 50. If they're starting to, if by that stage you've had sort of 7 or 8 months worth of deflation and they're actually starting to think, oh, actually maybe we've gone too far, it's hard to see them. Central banks don't tend to turn on a dime. They tend to go, oh, okay, we've just raised 50. Maybe we better sit still for 3 or 4 months first and just see what's going on. And so then you get another 3 or 4 months worth of sort of the negative effects before they finally go, oh, actually, we did go too far. Let's now go the other way. And the effect of that's going to take 3 or 4 months or 6 months to get through into the economy. And so that tends to be the way that they overdo it, and I think this cycle that is the most likely outcome, is that they're going to overdo it.
Well, and they've been talking about lags in the system. I mean, Phil Lowe the other week, when he was in front of Parliament, made that point that it takes time for these things to work. Typically, 12 to 18 months to see the impact, right?
Well, actually, I've got a chart which is Gareth Aird did this one. Put in one of his notes. So this is on a CBA one. He's just talking about how on the 4th of May, the RBA increased its cash rate by 25 basis points. So it took 1 month then for them to get their minimum monthly payments, and another 30. Then you got a 32-day notice period, and then you got your next full repayment cycle before it starts. And so it was the 3rd of August for CBA people to be paying higher minimum monthly repayments. Now, some banks are faster. It would have been a month earlier, but still, that was the first 25 basis point, hit people a month ago.
Yep.
So yeah, there's lags.
And I'll tell you, I'm seeing that in my surveys, right? So I'm seeing now people reacting to 2 or 3 months ago when the first changes were made, and now it's trickling through to hit their accounts. But it does take time. It really does take time to work through before people realise just how much they're being hit for.
Yeah, and as well, I think for a lot of people, there's a good argument to say, oh well, they've known this is coming for a while. It's been obvious and all that. But people don't.
No, that's not.
People don't look at that.
No.
And chances are for a lot of people as well, it's like, well, the money comes out of the bank account, and it'll take another month or two before they go, just a minute, my credit card's full, or just a minute, I've got no cash in the bank. Why is that? Oh, I'm paying $2,000 extra on this. I better cancel that gym membership. I'll cut back to 3 streaming services rather than 5. I'll whatever it is. There's the steps people take to cut don't usually come that first month. It'll for some people, obviously.
Well, some people are on top, but a lot of people, frankly, still have their head in the sand. And basically say, oh, she'll be right, bit typical Australian. But unfortunately, as the water keeps rising, right, your head's further and further underwater. So eventually something's got to give.
Yeah, absolutely. Yep. Absolutely. That's I've just got the chart up. So this was the one from latest property one, just sort of showing if you do a 1 month change in mortgage payments, it's almost 50%.
Yep.
And it's the highest basically, since 1960. I don't have data and go back any further, but I feel like 60 years is enough time to say it's a big change.
Absolutely, yeah. And of course, mortgages are big, so
yes,
it's not like it's a small amount, right? We were paying. Remember, if you look at the trend on average monthly repayments of the mortgage, they've hardly moved over a generation, right, as a percentage of income, right? But that's only because rates have come so low. So when rates start to go up, that means that the actual proportion of income you have to pay post-tax on your mortgage is going to go through the roof. And that's the bit that I think a lot of people haven't quite figured out yet.
And now you were saying in the pre-show that there's some extensions, so I thought that was really interesting.
Yeah. So I've been doing quite a lot of work on this and speaking to a few mortgage brokers and also people who have been on the receiving end. So some of the banks are saying, well, look, we'll offer you a restructure of your loan. You might have 15 years left, but what we'll do, we'll extend the length of the loan so that in the expectation of where rates are going, your monthly repayments won't change. Right? So what'll change is the duration of your loan. So that's beginning to be a get-out-of-jail card for a number of people who've got no other option, which is interesting. But, of course, you end up paying a lot more interest because you're paying, your term of your loan's being extended dramatically.
Yes.
And the interesting question about that, or the interesting observation, is you don't actually need to do a full review of the borrower to extend the term of the loan.
Right.
So that's different from, basically taking a new loan or moving to another organisation where you have to go a complete review.
Yeah.
So they can sort of do it below the waterline. So that's quite an interesting little observation.
It is interesting. And I was because I thought about it a little bit more, and I thought, well, so it's obviously, for the person doing it, it's a short-term gain for a long-term loss.
Yep.
But if you have to do it, you have to do it. I'm not saying people shouldn't do it. In the end, for some people, that means that's the difference between.
Well, it keeps you in the property. It keeps your cash flow where you need it to be.
Yeah.
And the fact you're paying twice as much interest over 30 years, well, do you care? And probably not. The bank, of course, will get extra value out of it because they're going to be, there for longer. So,
but that's I guess almost by definition, they're the people who might have been mortgage stressed, but probably weren't in danger of selling their house
it's the guys in the middle. So, I sort of say, if you think of the portfolio of borrowers, you've got 30% who are fine, they've got plenty of buffers, and their rates can go up 5%, there won't be a problem. At the other end, you've got people who are absolutely scraping on the bottom already, about 30%. You've got another 30% in the middle. And it's those 30% in the middle who are being helped by some of these strategies, because what it does, it gives them more wriggle room and more flexibility. It's not helping the people down the bottom, the people who are already right up against it with max credit cards, very high loan to value ratios, and frankly, no wriggle room at all. They are the ones still in great difficulty. And interestingly, I was talking the other day to a couple of debt counsellors, and they're saying they're seeing more and more people in that middle block reaching out for help to try and work out how to deal with this, right? The people down the bottom, there's very little they can do to help them.
Yep. Well, that's probably a good time for a switch to this, some of the housing valuations. So I run this house price model where basically I've got sort of this view in terms of housing I've come to over time, which is basically people will pay for whatever they can afford. So really in the end, it's an affordability measure that's sort of threefold. One is what's the mortgage relative to rent, with the idea that and actually I should have shown let me show a different slide first. So in Sydney at the moment, that's 231%. So basically, if you could rent a house for $1,000 a week, you can get a mortgage on that same house for roughly $2,300 a week. Is the thing. And so I guess what I'm saying there is there's a limit to that in terms of, once that ratio gets down under 100, then people start going, oh, it's actually cheaper to have a mortgage than what it is to rent. I'll buy a house. And when it gets to 2.5 times higher, I think the expectation is people, even though renting is difficult and rents are going up quite quickly, it's still a question of saying, well, I can afford $1,000 a week. I can't afford that $2,300 a week. So I'll take that mortgage. Then there's the mortgage to full-time wages. So one part is what is it relative to rent? The next part is what is it relative to full-time wages? And then finally, can I afford the deposit, which is it's important a little bit, but not as much as those first two. The first two is can you afford to service it, and then the last one is how much does it take you to how long will it take you to save for it? And those investment returns are sort of important, but not really at the moment. So as you can see, all those ratios, almost all well above 100. Once you get to the units, in Perth, you can still, the median house there is still cheaper for a mortgage versus rent. But keeping in mind, this is gross rent, doesn't include a whole bunch of costs, so it's not really cheaper. But just the raw numbers. In Sydney, it's almost 100% for your mortgage payment for a versus a full-time wage. Now, keep in mind, this is a full-time wage pre-tax. So one person on the median New South Wales salary can't afford to pay after tax, couldn't afford to pay a mortgage. The median couldn't afford to buy the median house. So that's one way of looking at it, is seeing all these and you go, well, yeah, units look cheaper and houses look more expensive, and it's a little bit harder to gauge that. So that's why I ran this other table that I showed first that I should have done the other way around, which is does everything as a percentile, where I've said, okay, 100% is as expensive as it has ever been, and 1% is as cheap as it's ever been. And so almost everything's, so in the houses, Perth's still got a little bit of, I guess, it's not horrendously expensive. It's only a little bit more average versus rents, but everywhere else is basically as expensive as it's ever been on most of those measures. Units is a bit more. There is, you look at Brisbane or Perth, and there's you can make an argument versus a full-time wage. It's actually a little bit cheaper than it's been sometimes in the past. But it's there's a lot of red on that chart at the moment. It's and then sort of graphically to show you, say Sydney, this is just those same numbers. So you can see that this is the mortgage payment versus median wage. Around 50% is sort of roughly where it's averaged over that longer term. This is sort of back to 1980, so it's 40-something years. It's been roughly 50%, and we're almost 100% now. I've basically had to redo all the y-axis on these charts last month. Your mortgage payment to rent seems to be Sydney houses is like you get below 100%, seems to be bottom out, gets to 200%, it seems to top out, or even sort of 170%, I guess I'd say, and we're at 230 at the moment. So it's up there, and there's more rate rises to come.
Well, that's the point, isn't it? Because this is a dynamic situation, and we know it's going to get worse. And it's interesting because I'm just running my September stress analysis at the moment, which I'll be presenting next week on the live show, and we're seeing significant spike in rental stress. So rental stress is really now binding a lot of people, and that's partly because of the lagged effect of people putting in rent increases, as well as people moving around and those sorts of things. The mortgage stress is still very high and continuing to rise, although some people got a little bit of a wriggle room because of the low wage increases that happened a month or two ago. And some of these restructuring things I mentioned are giving people a little bit more wriggle room. But net, it's a pretty sorry story, and we're only in the early foothills of what's going to happen.
Yeah. Well, and I think I need to keep reminding myself of that when I look at this. I'm like, how can this be, still acting this way? The housing market not tumbling yet, but the reason is because that 230%. Well, we're probably only at 170% or 180% in terms of what people have actually seen in their bank accounts.
Absolutely,
and they're still that affects.
It's laggy, and of course, this was this Chris Joyce chart from the other day showing that prices are tipping down now in Sydney, Melbourne, and Brisbane, and the 5 capitals. And, I'm seeing now evidence, and in fact, Cookie was helping me the other day with some of the, looking at some of the reset prices on the portals. They're all dropping. So pretty much everywhere, even places like Perth, Tasmania, and South Australia to an extent as well. So pretty much everywhere now, we're starting to see the early signs of things sliding down.
So what was it? The reset? What did you call it? The reset prices? Sorry.
So basically, when you see an offer over on a portal, then they cross it out and say, "Well, we're now offering at a lower price." Right?
Oh, okay.
First time ever at this. So we're seeing a lot of those discounts, those reductions, price reductions, and some of them have been around for a little while, and we've seen several price reductions. But even properties that have been listed quite recently seem to drop their prices much more frequently than they used to. So it's sort of another leading indicator, not scientific necessarily on its own, but when you put this together, when you put it with your charts and you put it in my stress charts, and you see some of these other movements in terms of what the property price portals are saying, the evidence is getting stronger and stronger that we're in for a significant move down in property prices. And with rates still going up, and I just remind you again, 4.3% by the end of next year, right, is what the markets are saying, which means the mortgages are going to be at 7% plus, potentially then. That's significant. Yeah.
Well, and we still haven't seen, a lot of those fixed mortgages.
They're rolling over too. So.
Yeah, is sort of late next year, I think, is it?
Well, so some were 2 and some were 12 months, some was 2 months, 2 years, and some were 3 years. The bulk on the 2 and 3 years. So basically, the next 12 months, we'll see a lot of those shake through.
Yeah, because I feel like there was a few coming this sort of half.
Yep.
And then
next half.
Yeah, next half is starting to get into the.
It's a Christmas present in the first part of 2023. Right?
Yes.
So. I think we've looked at that in a really good amount of detail, and thanks for doing that. Now, I had a couple of questions from beforehand that people threw at me, and I wouldn't mind just bowling them at you. So this is from Billy, this one. So he's got a super fund. It's actually with one of the big super funds, but it includes a lot of unlisted property. Yeah. And he's trying to get some information as to what the valuation of that unlisted property is, and he's not succeeding. And I guess the question is, when it's unlisted property, how on earth can you get any sense of what the thing is actually worth? And in fact, how do you know what the value of that part of your super is? It's very tricky, it seems to me.
Yeah, absolutely. I mean, they've got to have rules around it, but it's let's just say there's a fair bit of give to a lot of these things, like, especially when asset prices are falling. Like this is the argument that there's two sets of arguments that super funds will run on these. One is that these assets are less volatile than other assets, and it's like, well, they're the same assets. If it's owned by if it's listed on the stock exchange or not listed on the stock exchange, it's still, you own an airport, you own an airport. It's just that one of them, you can see the price going up and down every day. The other one, you can't see the price going. And so they only market to market every quarter or whatever it is. And they can make assessments on saying, well, yes, that airport might have fallen by 30%, but we think ours is a better airport and we haven't got as much debt, or, there's whatever reasons. And so we're only going to market down by 15. So the issue with that is, I spoke a lot about this when in the middle of the pandemic, when all the super funds that had the most amount of these unlisted assets, they'd done the best because they hadn't marked down the value of their assets. So they've got whatever it is, 40% in unlisted assets. The stock market's fallen 50%, so 60% of the portfolio has fallen 50%. The other 40%, they've said, oh, that's fallen, whatever, 20%. And so it looks like your performance is good. So if you're selling out of that thing, you're like, okay, I'm doing better than if I had had all my funds invested in the market. The problem is most people aren't selling out. Most people are putting more money in every month when you get and so every time you're putting more money in, they're basically selling you they're selling you the same airport that you could have bought somewhere else for 50% cheaper for that same price. So that's one side, and they'll come back and say, "Oh, our fund is a lot less volatile than else because we've got these assets." And the other one is Host Plus gets blamed for this all the time. Is some super funds will call these assets defensive assets rather than growth assets. And so whenever you see all the league tables for how super funds are doing, it's based on what their strategic asset allocation is. So basically, if you've got one fund that's got 50% equities and another one that's 50% equities and 50% bonds, and you've got another one that's got 80% equities and 20% bonds, they don't get compared on the same one. They'll say, okay, let's get all the people who've got round about 80% and compare them with each other, and all the people who've got around about 50%. The thing is, Host Plus keeps on saying, well, we've got these assets that other people like ourselves would treat as growth assets, but they treat them as defensive assets. And so when stock markets go really well, Host Plus almost always sits at the top of the table because they're basically going, they've got 90% equities, and they're comparing it. They're getting compared to everyone else who's got 70 or 80%. And so, knowing what your super fund is actually doing with it is knowing it in a broad sense what they're doing is important, so you can understand a bit better about how the performance is going to do. As you asked that question about, he was wanting to understand these assets. What I was thinking was good luck. Because I
think that was the point. He'd spend a bit of time trying to and realised basically he'd been sold a pup, right? And I said to him, have you looked at the REIT ASX 200, right? He said, no. I said, well, have a look. There we go. So yes. This is the ASX 200 REIT, right? Real Estate Trust. And you can see that it reached a peak of nearly 1,800, right? It's now down at 1214, right? Well, that might give you a bit of a clue.
Yeah. Now I haven't got the recent ones for it, but I know that other big drop you can see. Oh no, that's 2020. Okay, sorry, I thought that was 2000. I know when they fell. There was ones where some of these trusts fell. So they dropped 60-70%. I think dropped in
2009.
Yeah, was it? So they were 70% more.
Yeah, so they were about. If you look, this was 2007. It got to 2480, and it dropped back to 600.
Yeah.
So that was a really 70%
ish. Yeah. So at that time there were unlisted trusts out there that were trying to tell everyone that their assets were only down 30%.
Yep. Exactly.
And they'd closed up, so you couldn't take your money out. Yep. But they're only down 30%, so don't worry about it, Martin. You'll just get your 30% back, and they had to wait, a few months and all that sort of stuff. But yeah, it was it's that part where if you've got these unlisted assets, you just don't know what you don't know what they're trading for, and the thing is, if you're putting more money in, chances are you're buying it at those inflated prices.
Absolutely. And because it's not transparent and it's illiquid, there's a whole bunch of questions, right?
Yeah, well, if you end up, not that there's as much of a worry now as all the super funds, these super funds get bigger and bigger, but if you were in a smaller super fund and there was a run on the assets, like let's say they owned, you've got a super fund that's got 50% unlisted assets and 50% listed assets, and some bad headlines come out about that super fund and people start taking their money out. And the super fund hasn't marked down the value of those unlisted assets as much as they should have. They can't sell them because when I turn up and say, "Oh, can I have my whatever $200,000, $300,000 back?" They own an airport. It's worth $100 million, $200 million, whatever it's worth. They can't just go turn around and collect it. So they have to sell the listed stuff. And so what happens is the people who are left just end up with more and more of this. Like all the good assets, all the liquid assets get sold to the people who are headed at the door, and all the loyal customers end up with more of this stuff at inflated prices. Yep. And so that's your other problem with that is if you ever get stuck in one of these or if you're the loyal customer when you get a bad headline, it can be devastating to the actual profits.
Absolutely. Now, the other question this is from Chrissy, who said, everybody says, well, you should go to cash, but what actually does go to cash mean? And are there traps there for the unwary?
There are hundreds of traps in cash, yes. Okay, so the bank is the first part, yeah. There's a thing called reaching for yield. This is where everyone goes unstuck. And what it means is that you can get a 3% yield or 4% yield in the bank, and then you go, oh yeah, but here's this some other asset and I can get a 5 or 6% yield, and then once you've got that one, there's another one you could get a 7 or an 8% yield or whatever it is. And the problem is there's cash and there's products that are dressed up to look like sort of cash type products, and some of them are really just debt. And sometimes they're things like, they often call them things like mezzanine funds and things like that. And basically what they are is quite risky debt assets, usually backed by property or something like that. And to get you this quite high yield, but you're taking a lot of risk on. And so, looking for cash products, knowing what's behind it. There used to be a bunch of ones that would run, that treat it like they'd make it look like it was a deposit, but really it wasn't. It was your money was then getting taken and funneled usually into some sort of property scheme is the most likely thing behind it. That's one. Hybrids are, I like to say, have all the upside of debt, which is basically none, and all the downside of equity, which is lots. So the problem with a lot of hybrids is when things go well, the equity holders get all the upside, and you just get your return and your money back. But if things go badly, then you can find yourself losing quite a lot of money on some of those hybrids. And so there's most institutional investors won't invest in hybrids. So there's better risk return out there just getting direct corporate debt. So the real benefit for hybrids, is that they're listed, and so people can see them, and in particular stockbrokers can buy them and put the clients into them. So which for some people is a benefit. For me is actually not just being there and is not actually a benefit. So if you want, there are some government bonds which you'd call cash-like, but where it's quite short term. If you're longer than, say, definitely longer than 6 months, but you'd probably be want to only have a month or a couple of months of on those government bonds if you're looking for that. There are various types of deposit guarantees that you can get. So that sort of makes a bit of it is important in terms of knowing, if you're concerned about real big downturns, you might not want to have all your eggs all in the one basket. I do think that most of the big banks in Australia are, well, they're implicitly sort of guaranteed and probably explicitly guaranteed as well if push came to shove. But if you took all your cash and put it into some small building society that you've never heard of because they had the highest rate, I'd be a bit concerned about that because things can happen. Housing markets crashing, and
it's worth reminding everybody that a deposit into a bank is an unsecured loan to the bank.
Yeah. You're very. Having said that, So technically, yes. You're a long way down. So if things go wrong, the equity holders lose their money, then the hybrid holders lose their money, then the debt holders lose their money, then the next set of people which have got to, and then you've got some junior and some senior bonds, and you're a long way down before you get to the deposits. So you can get bailed in, but my take is that, look, in a serious, if there's a serious financial crisis in Australia, then you would see the Australian government step in and back the major banks at least, and probably try and get a lot of the little ones to merge into the major ones. You'd basically, if they were the government that allowed a major Australian bank to fall over, would be sort of setting itself up for opposition for the next generation. So having said that, there's not to say that you couldn't, there's other things that, it wouldn't be a pleasant experience, might not be a pleasant experience for you, but you certainly, if you're concerned about it, don't stick all your money into a small bank, because they're the ones that they might let fall over with a view that, that'll be a lesson to everyone else. That the banks can fall over. And a better governments, say more mature governments, you'd expect to actually make people take some pain, make the bank lenders and everything take some pain. That hasn't been the experience over the last few cycles. So, it used to be 30, 40 years ago when these things go wrong, okay, people who lent the bank money, okay, you've lost whatever you've lost, and these people have lost a bit, and the next ones have lost a bit, and people feel some pain. Whereas the last round we had in the financial crisis was basically, all these debt holders got bailed out. So if they're bailing out debt holders, then depositors are even safer.
Yeah, and APRA keeps assuring there's nothing to see here. It's all fine, folks.
That's right.
Exactly.
Move along.
Good old APRA. Yes. Now, here's a quick question for you. We're getting to the end of the show, but this is quite an interesting one. Are we in recession already, says Blue Army, and thanks for the super chat. Interesting question. Not technically, I think, is the answer, isn't it?
Not technically, no. Look, quite possibly. I think there's... I think the US is probably a little bit further along in terms of where it's at. Are we in recession already? We're close. We're close. Quite possibly. And I do think that central banks have already gone too far, and that it's not, they can't pull it back. We're headed for recession absent some major external event. But I think probably the bigger message from everything we've shown you is, well, things have turned pretty decisively down across most of these leading indicators.
Yep.
Some of the coincidence, so there's sort of three sets of indicators. There's the lagging indicators, which are the really good ones that tell you all the information, but they just come too late. There's the coincident ones that sort of tell you this is what's happening right now, and but again are a little bit late. And then there's the leading ones. And the leading ones have all turned pretty decisively down. The coincident ones are starting to look a little bit dicey. And so, the lagging ones haven't shown up any signs yet. Now, the central banks seem to be focused largely on the most lagging ones, which is inflation and unemployment. But which is why, my expectation is they'll keep raising rates, and we'll have a pretty decent downturn.
Yeah, and my take, looking at the data from small business and the data from households, is that many households and small businesses feel as though they're in recession, whether it's formal or not, which is one of the reasons why household confidence is so low.
Yeah. And actually, it's probably the biggest definition which is the unemployment side.
Yep.
And so that hasn't been. We're not in recession from an unemployment perspective.
But that's artificially low because of the migration turned off for a long period of time. Migration is now being turned on again, so that's going to have an interesting impact.
Yeah, and the other one on that part is, I might have spoken about it last time, is that thought that, if you're Woolworths and somebody was sick 3 or 4 years ago and had the flu, you're like, okay, you're sick, you've got the flu, I'll see you tomorrow or the next day when you're better. Whereas there is an expectation now. Well, one, a lot of these people end up having COVID, and so they've got to take a week off or longer, a little bit longer ago. But even normal sicknesses, I think there's more scope for people not to turn up to work. And so what that ends up happening is they just hire some more casuals. And so they might not end up paying that much more in terms of salary bills because, one casual didn't turn up and I moved another casual in, but the employment's a lot bigger for that. And so, I do think there's an aspect of that's sort of hidden within the numbers. And we also had a lot of people retire early as well. So, pandemic came around, lost their jobs. That sort of flushed out a lot of people from the market who just aren't coming back. And so, there are some, as you said, there's some distortions to that labour market.
Absolutely. Now, Jason asked this question or made a comment, and thanks for the super chat. The chain of payouts in a failed bank looks seriously sad from my understanding. Couldn't APRA take over and manage it out? Well, APRA has an arrangement with each of the banks, a sort of a workout arrangement, theoretically, in the case of something going wrong. Banks are required to have that. And APRA is responsible for managing out that situation. So they could try and do it silently. That's certainly possible. And there have been examples previously where effectively, like Bankwest was sort of sucked into CBA to protect the Bankwest business through the global financial crisis. So there have been some examples of that. And the question is, what happens if many banks get into difficulty at the same time? In that nightmare scenario, I'm not quite sure how it all works out, not least because the overall amount of deposit guarantees in the system is about 20 billion maximum per bank. So there isn't enough in the kitty to cover everything. Yeah,
I think the key ones for this is is distinguished between what we call liquidity and solvency.
Yep.
So liquidity is everyone wants their money back from this bank because they've heard that it's going to go under, and so everyone's trying to take the money out all at the same time. And that's the ones where governments can step in. We saw that in the financial crisis for was it Bank of Scotland? No. There was a US one. Sorry, not a US, UK one where that was effectively what happened. And often those ones, the government actually ends up making money out of the deal because they step in, they take over the bank, and they manage the liquidity and they come out.
NatWest in the UK.
NatWest, sorry, that was the one. Yeah,
it was RBS and then NatWest. So
yes,
they changed the name. RBS was the biggest, right? And they were highly exposed, as you say, the government.
And Northern Rock, that was the other one I was thinking of.
The Building Society. That was, of course, the one that created all of the headlines when people were queuing outside. Yeah.
Yes.
Yep.
And
interestingly, the thing that really triggered that was the reporter standing outside the Building Society saying, "There's no problem."
Yeah, that's right. Nothing to see here. Yeah. Yes. Okay, so there's that, and then you get these solvency issues, as you said. So the way for big ones, how it tends to happen in when you get really big solvency events that affect entire banking systems, is they tend to create what's called bad banks. And so the government will create a bank that bundle all these loans into it and then manage that out. And that was China's a good example of doing that. And then that basically that thing then turned into a hedge fund that started taking bribes from people taking bribes from other people to let them put their bad debts in there, and the guy ended up getting hung, I think, who was running that. But yeah, there's but a bad bank is quite often a way where they basically say to the banks, okay, you give us all your bad assets, we'll sit there and manage those out over a longer period of time, and then you can go back to being a normal bank and lending and all that type of stuff with all these bad assets, and that sort of gets the economy going again. Now, ideally, in that scenario, the equity holders really lose out, and the bond holders lose some money. I suspect why Australian banks are priced so highly, as you said, Martin, is because people have this vague suspicion that APRA and RBA really wouldn't make the equity holders pay as badly as they should.
No. There is an implicit guarantee perceived to be there from investors internationally into the Australian banks, particularly the large ones. That's why they tend to have a rating closer to the country rating than they should.
Yes,
that's the reason. Yeah, well, we've run out of time. Let me just drop the. Let's have a look at the poll. So we asked, in a year's time, where will the Aussie US dollar be? It's currently 64.88. Above 80, 12%. 70 to 80, 16%. 60 to 70, 31%. Below 60, 41%. So the consensus is that it will be below 60. I don't know, what do you think, Damien? Where it will be in a year's time?
In a year's time. Well, look, on current projections, I think I'm in the below 60 camp. Probably not a long way below 60 though. Yeah. Unless I'm sort of under the expectation that, look, the RBA will find it easier to reverse course than the Fed. But that's and they do tend to be more. They do in the past. They have tended to turn relatively quickly at times, and so I'm expecting that they'll see enough of an event to turn, and also that the US is in front of us as well in terms of the cycle. So the US might have started being. I guess if the US is starting to see worse things because they're already a fair bit further in front of the cycle, and we're seeing bad data starting to come out in ours, then we might be able to turn in time. But it's we're waiting to see how big the policy area is going to be at the moment. Yep. And if the policy area is huge, then the Aussie dollar is definitely going.
The point is, there's going to be a policy area. The question is, how big is it? Right? It's exactly. Not will they, won't they? Yes, they will. How big, seems to me. And just quickly, Jason made this point. Would the bank, would the government have to step in? Yeah, I think the bank would. I mean, APRA is in charge, but APRA, of course, would do that in consultation with the Treasury. That's typically the way that those things would work, just to explain that. And there was one other quick comment I saw from Stripey Cat. Another great show. Thanks for the live DS show. You're welcome, Stripey. Thanks for the super chat.
We've got some DFA hoodies.
There is some merch. Conference. There is some merch on the channel. Yeah.
Okay.
But they're made on demand, so you have to actually rather than actually physical. And we will just remind everybody again that there is this event down in Melbourne. I think it's on the 19th of next month. There's a link below, and if you'd like to sign up and register to go along, you can meet Damien and the macro business guys in person. I'll be joining virtually, so mark your diary for that. Damien, I want to say thank you very much. Really appreciate your time as always, and so much to talk about. We could have gone on for another hour and a half, but I think we've probably exhausted
we barely touched China, and we barely touched European energy. So
I know. There's always more to talk about, but look, it's really important.
We'll be back next month.
Yeah, exactly. We'll do some more next month. So thank you very much for that, and I'll take you offline now and close out the show.
Thanks.
See you later. Cheers. Okay, so there we go. I hope you enjoyed that, and some very important points there. In terms of next week, it'll be me. I'll be coming on and talking about my scenarios and household stress and the postcode engine and all that, so you can ask specific questions about postcodes. The dynamics in the market are moving quite quickly, so it'll be quite an interesting conversation, so mark your eye for that. And meantime, check out the recorded shows that will be coming up over the next few days. Quite a few different things on at the moment, including Tarek at the end of the week for his fortnightly slideshow, so that should be worth watching too. So thank you very much. Hope you enjoyed the show this evening. Thank you for all the super chats. Thanks for all the comments, and we'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off. Cheerio.